Most people believe building wealth starts with earning more money. It doesn't. Thousands of people earn six figures every year and still retire with little to show for it. Wealth isn't determined by your paycheck. It's determined by the financial decisions you repeat month after month. Millionaires don't win because they're lucky. They win because they follow financial rules that compound over decades while everyone else chases short-term comfort. Today, you'll learn 9 money rules that quietly separate people who build lasting wealth from those who stay trapped in the paycheck cycle. Your salary tells you how much money flows into your life. Your net worth tells you how much wealth actually stays. 2 people can each earn $100,000 a year, yet one retires wealthy while the other lives paycheck to paycheck. The difference is simple. One consistently converts income into assets, while the other converts income into expenses. Wealth isn't measured by what you earn, it's measured by what you own after subtracting what you owe. High-income earners often confuse cash flow with wealth. A luxury car financed over 7 years may impress people, but it doesn't increase your net worth. An investment portfolio, income-producing real estate, or shares in profitable businesses quietly increase your financial position every year. Millionaires don't ask, "How much did I make this month?" They ask, "How much did my net worth grow?" That single question changes every financial decision you make. The fastest way to stay broke isn't earning too little, it's increasing your lifestyle every time your income increases. This is called lifestyle inflation, and it's one of the biggest destroyers of long-term wealth. Every raise becomes a bigger house, a newer car, or more expensive vacations instead of a larger investment portfolio. Wealthy people reverse this equation. Before they reward themselves, they buy assets that generate future income. The asset eventually pays for the lifestyle, not the paycheck. Every dollar can only be spent once. If you spend it on a liability, its earning potential disappears. But if you invest it in an asset, that same dollar can produce dividends, capital gains, rental income, or business profits for years. The wealthy understand a powerful principle. Never let today's consumption steal tomorrow's cash flow. Financial freedom isn't built by buying more, it's built by owning more. The average person spends money first and wonders where it went later. Wealthy people do the opposite. They assign every dollar a purpose before they receive it. This is called intentional cash flow management. Every dollar must perform one of 4 jobs: cover essential living expenses, eliminate high-interest debt, purchase appreciating assets, or generate future income. If a dollar isn't moving you toward one of those goals, it's probably moving you away from financial freedom. The richest investors don't have extra money, they simply waste fewer dollars. Here's where most people unknowingly lose the wealth game. Imagine investing $500 every month into a low-cost index fund, earning an average 10% annual return. Over 30 years, you would contribute $180,000. But thanks to compounding, your portfolio could grow to well over $1 million. Now imagine spending that same $500 every month on things that lose value the moment you buy them. The cost isn't $500, it's the $1 million portfolio you never allowed to exist. Every purchase has an invisible price, the future wealth it could have created. Most people obsess over finding investments that earn 8%, 10%, or 12% a year, while completely ignoring the guaranteed losses sitting in their wallet. Every dollar trapped in 20% credit card debt is mathematically earning negative 20%. No stock, ETF, or mutual fund can reliably outperform that kind of guaranteed loss year after year. Before chasing high returns, eliminate high-interest debt. Paying off a 20% credit card is often the equivalent of earning a risk-free 20% annual return, something even the world's greatest investors would gladly accept. The wealthy understand that interest works in 2 directions. When you invest, compound interest becomes your employee, multiplying your wealth year after year. When you borrow at high interest, that same mathematical force works against you, quietly transferring your future income to the lender. The difference between becoming wealthy and remaining broke often isn't earning more. It's deciding whether compound interest is working for you or against you. The moment you eliminate expensive debt, every future investment begins compounding without a financial anchor dragging it down. Many people believe becoming a millionaire is the ultimate financial goal. It isn't. Cash flow is what determines whether you stay wealthy. A person with a $5 million net worth tied up in expensive homes, luxury cars, and illiquid assets can struggle to pay monthly bills. Meanwhile, someone with a $1 million portfolio, producing $60,000 to $80,000 in annual passive income, may never need to work again. Wealth isn't about owning expensive things. It's about owning assets that consistently send you money whether you wake up to work or not. Your financial independence begins the day your investment income starts paying your living expenses. The financially free don't ask, "How much is this asset worth today?" They ask, "How much cash will this asset produce over the next 10, 20, or 30 years?" That's why experienced investors prioritize businesses with growing earnings, dividend-paying companies, rental real estate with positive cash flow, and diversified index funds. They focus on income-producing assets, not status symbols. Every new asset becomes another employee working 24 hours a day, sending cash back to the owner. The objective isn't simply to become rich, it's to build a financial machine that keeps paying you long after you've stopped working. The biggest financial mistake isn't buying expensive things, it's buying things that permanently steal your future investing power. Every dollar you spend today has an opportunity cost. That simply means it could have been invested to generate returns for decades. For example, $10,000 invested at an average 10% annual return doesn't just become around $26,000 in 10 years. Left untouched for 30 years, it could grow to more than $170,000 through compounding. Before every major purchase, ask yourself one question: am I buying this item, or am I giving up the future wealth this money could have created? That's how investors think. The wealthy don't use money to buy status, they use money to buy time. Every dividend, every rental payment, every business profit, and every capital gain reduces the number of hours they must sell to earn a living. This is why financial freedom is measured by time, not dollars. Calculate your freedom number. Divide your annual living expenses by a conservative withdrawal rate, such as 4%. If your expenses are $40,000 per year, you'd need roughly $1 million invested to potentially support that lifestyle over the long term. Once your investments consistently pay your expenses, work becomes a choice, not a necessity. That's the moment money begins working harder than you do. Most people think their money is safe because it's sitting in a savings account. In reality, if your money earns 2% while inflation averages 3 to 4%, you're losing purchasing power every single year. Your bank balance may look larger, but your money buys less food, less housing, fewer investments, and fewer opportunities over time. Inflation is an invisible tax that punishes savers and rewards investors. That's why wealthy people don't let large amounts of cash sit idle. They own productive assets that have historically outpaced inflation over the long run. This is why the wealthy focus on real returns, not just returns. If your investment earns 10% in a year, but inflation is 3%, your real gain is roughly 7% before taxes and fees. Over decades, that difference becomes enormous. Investors who consistently own broad market index funds, quality businesses, and other productive assets aren't just chasing higher returns, they're protecting their purchasing power. The goal isn't to make your dollars grow, the goal is to make sure your future lifestyle grows faster than the cost of living. That's one of the deepest principles of long-term wealth creation. One of the biggest mistakes beginner investors make is obsessing over stock prices instead of business quality. A stock is not just a ticker symbol on a screen, it's fractional ownership of a real business. Professional investors ask questions most people never ask. Is the company's revenue growing? Are profits increasing every year? Does it have a competitive advantage? Is it generating strong free cash flow? Can it keep paying and increasing dividends? Is management allocating capital wisely? These are the questions that separate investors from gamblers. The market rewards business performance over decades, not daily price movements. Here's what separates the top 1% of investors from everyone else. They understand that price is what you pay, but value is what you own. Markets can panic. Prices can fall 20%, 30%, or even 50%. But if the underlying business continues growing earnings, expanding cash flow, and increasing intrinsic value, temporary price declines become opportunities, not disasters. That's why disciplined investors continue buying quality assets during market downturns, while emotional investors sell in fear. The greatest fortunes in history weren't built by predicting the market, they were built by consistently owning exceptional assets for decades. Here's one of the biggest financial misconceptions in the world. A high income does not guarantee wealth. Thousands of people earn $300,000 or more every year and still live paycheck to paycheck because every dollar they earn is immediately spent on larger houses, luxury cars, expensive vacations, and lifestyle upgrades. Meanwhile, someone earning $70,000 who consistently invests 25 to 40% of their income into productive assets can quietly become financially independent. Income creates the opportunity to build wealth, but ownership is what actually creates it. Every share of an index fund, every dividend-paying stock, every profitable business, and every cash-flowing asset you own becomes another engine producing wealth long after your paycheck stops. The richest people on Earth rarely became wealthy because of their salaries. They became wealthy because they owned appreciating assets that continued growing whether they were working, sleeping, or on vacation. This is the mindset shift that changes everything. Stop asking, how can I make more money? And start asking, how can I own more assets that make money? That single question separates consumers from investors and employees from owners. Your salary can stop tomorrow, but a diversified portfolio of productive assets can continue generating income for decades. Don't build your life around a paycheck. Build it around ownership. That's how real financial freedom is created. Most beginners waste years trying to find the next Apple, Nvidia, or Tesla. Professional investors spend far more time deciding how much of their money belongs in each asset class than which individual stock to buy. This is called asset allocation, and research has shown it has a major influence on long-term portfolio performance. A diversified portfolio might include broad market index funds, international stocks, high-quality bonds, REITs, and a cash reserve for opportunities. Diversification isn't about maximizing returns every year. It's about staying invested through every market cycle. The investor who survives every crash is usually the one who wins. The greatest risk to your wealth isn't market volatility, it's making emotional decisions. Fear makes investors sell during crashes. Greed makes them buy after prices have already exploded. Successful investors do the opposite. They rebalance, continue investing on schedule, and let time, not emotion, drive their returns. Your portfolio should be built to survive recessions, inflation, bear markets, and economic uncertainty. Anyone can make money during a bull market. The people who become truly wealthy are the ones who stay invested through every market cycle. That's the difference between temporary profits and generational wealth. Most people spend years searching for the perfect investment while ignoring the variable that creates the biggest difference in the early stages of wealth building: how much they consistently invest. During your first decade, your monthly contributions usually matter far more than squeezing out an extra 2% return. Someone investing $2,000 every month into a simple low-cost index fund will often outperform someone investing $200 per month into the world's best-performing stocks. The truth is uncomfortable. You don't have an investing problem. You have a cash allocation problem. Every raise, bonus, side hustle, and tax refund should increase your investment contributions before it increases your lifestyle. Wealth accelerates when your savings rate rises faster than your spending. The truly wealthy automate their investments because they know behavior beats intelligence. They don't wait until they feel like investing or try to predict the next market crash. They invest every payday through dollar cost averaging, DCA, buying more shares when prices fall and fewer when prices rise. Over decades, this removes emotion from the process and allows compounding to work uninterrupted. The market doesn't reward the smartest investor. It rewards the investor who stays consistent the longest. That's why fortunes are rarely built in one spectacular investment. They're built through thousands of ordinary investments made with extraordinary discipline. Building wealth is only half the game. Keeping it is the other half. Many people spend decades accumulating millions, then slowly destroy their portfolios by withdrawing too much, selling assets at the wrong time, or paying unnecessary taxes and fees. Wealthy investors think about the distribution phase long before they reach it. They ask, how much can my portfolio safely generate without running out? Instead of constantly selling their investments, they build portfolios that produce dividends, interest, rental income, and business cash flow. Their goal isn't to spend their assets, it's to live on the income those assets generate. That's the difference between being rich for a few years and staying wealthy for life. The wealthiest families don't think in terms of one lifetime, they think in terms of multiple generations. They build investment portfolios designed to survive inflation, recessions, taxes, and market crashes while continuing to compound for decades. They diversify their income sources, reinvest a portion of every distribution, and protect their capital from unnecessary risk. This is why many fortunes last for generations, while lottery winners often lose everything within years. Making money requires skill. Keeping money requires a system. Growing money for generations requires discipline. The ultimate goal of investing isn't simply to become rich. It's to build an asset base that can continue creating wealth long after you're gone. Most people spend their entire lives chasing a retirement age. Wealthy people chase financial independence. Those are not the same thing. Retirement means stopping work because you have to. Financial independence means work becomes optional because your assets produce enough income to pay for your lifestyle. This is measured by your financial independence number, the amount of invested assets required to generate enough annual income to cover your expenses indefinitely. The lower your expenses and the higher your investment income, the sooner you reach true freedom. That's why increasing your income is only half the equation. Controlling your expenses accelerates financial independence just as much as earning more. The world's greatest investors don't measure success by how much money they earn each year. They measure it by how many years they could live without working if their salary disappeared tomorrow. That's the metric that matters. Ask yourself this question: if your paycheck stopped today, how long could your investments support your lifestyle? 1 month? 6 months? 5 years? Forever? Every investment you buy increases your financial runway. Every unnecessary debt reduces it. The ultimate scorecard isn't your salary, your job title, or your net worth. It's how much of your life is financed by assets instead of your time. That's the moment you stop working for money, and money starts working permanently for you. If you've watched this far, you've probably realized something uncomfortable. Building wealth isn't complicated. It requires doing the opposite of what most people do. Most people earn, spend, borrow, repeat. Investors earn, invest, own, compound, repeat. The gap between those two paths isn't obvious after 1 year. It's barely noticeable after 5. But after 20 or 30 years, it's the difference between depending on a paycheck and owning enough assets to finance your entire life. The market doesn't reward effort, it rewards ownership, it rewards patience, and above all, it rewards consistency. That's the wealth formula nobody teaches in school, but it's the one followed by almost every self-made millionaire. So here's your challenge. Don't try to change your financial future next year. Change your next paycheck. Decide today that a fixed percentage of every dollar you ever earn will purchase productive assets before it buys a better lifestyle. Then repeat that process every month for the next decade. That single habit has created more millionaires than chasing hot stocks, timing the market, or waiting for the perfect opportunity ever will. Your future wealth won't be determined by one brilliant decision. It will be determined by thousands of disciplined ones. The question isn't whether compounding works. The question is whether you'll finally let it work for you. If this video changed how you think about money, subscribe to Broke to Built, because your financial freedom begins with the decisions you make today.